Things are still changing and more clarity is coming. Now, this is a big benefit for real estate investors, but frankly, it's a big benefit for everyone because every single tax bracket is impacted and additional tax brackets have been added. And then you would qualify for up to $10,000 in deduction on auto loan interest.
We were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amos. We are back, another solo episode. These have been fantastic. Well, I should tell you the Real Estate Educators Podcast is brought to you by Pine Financial Group. So if you're looking to be a passive real estate investor or an active real estate investor, you're out there investing in funds or syndications, or you're out there fixing and flipping properties, building a rental portfolio, Pine Financial would love to help you out. You can get more information on how that is possible at pinefinancialgroup.com. Otherwise, if you're out there educating investors or you're out there investing in yourself, this is the podcast for you. So there we go. Now I'm back. We're back with a solo podcast. So these are pretty fun, pretty unique because I don't have anybody else on here with me. Makes it a bit more challenging. But the good thing is I get to talk about exactly what I want to talk about. And today is no exception. We're going to be talking about the big, beautiful bill that has just passed and how it's going to impact you and your taxes. So I've got some information here that you may like, maybe not, but I think most of it is very beneficial for real estate investors. So I think this is going to be a good episode for you. But I'm also going to talk about some of the things that are in the bill that you're not seeing in the media, you're not seeing in the news. So stick with me. Here we go. Let's talk about the one big, beautiful bill, Donald Trump's bill that is impacting taxes and significantly to real estate investors. And I didn't say this yet, but I hope you get a lot of value out of this episode and all of our episodes. And if you are, please 5-star review and share this with a friend. Would really appreciate that. I get feedback constantly about how people are loving this podcast and they're tuning in every week, but they're not leaving reviews. So help me out, please. 5-star review. Okay, so what happened here and why I'm talking about the big, beautiful bill is because I got an email from, it's actually D.A. Davidson, which is an investment banking company that I've worked with on another project in the past. So somehow I got on their email list. They sent me an email with some information on this bill. And I got to tell you, it was the most comprehensive of anything I've ever seen. So a lot of the information was, well, there's this section of the bill, and there's this section of the bill, and there's this section of the bill, and it was like trying to piece it all together was rather confusing. And quite frankly, there's things still changing, which I don't even know how that's possible, but things are still changing and more clarity is coming. But this email with this attachment really got me thinking. I was like, maybe, this is going to impact me and I'm going to do some things differently based on the information I'm reading about this. So I thought it would help you as a real estate investor and a real estate educator. Now, even that email with D.A. Davidson had missed some things that I knew were in the bill. So I responded to it, seeing if they wanted to add that to their document. I haven't heard back yet if they took that feedback or not, but I compiled what they've sent, which is mostly what they sent and some of what I've read and heard and researched, and I combined them for this episode. So here I'm going to go through the top aspects of the bill that will impact you, the real estate investor. Then I'm going to go into a little bonus round and go through some of the things that may or may not impact you, but you should know about them because there's the potential for impacting you. It's not real estate investing specific necessarily, but it has a chance to impact you and save you money or put money directly into your pocket. So, first of all, I am not a tax professional. I am a real estate investor. I am a real estate lender. I am not a CPA. I have no qualifications, frankly, to even be doing this episode. I do think you're going to learn something and get some benefit from it. But anything I say, please go to your CPA and check with them to make sure that the information is accurate. Okay, got to get that out of the way. Okay, so number one, the biggest thing in the big, beautiful tax bill is, or I keep saying it's actually one big, beautiful tax bill, OBBB. But one of the biggest aspects of this is the extension of the tax brackets and tax cuts from the Jobs Act. I think that was in 2017. So those were set to expire, go back to the old brackets, the old tax rates, and the big, beautiful bill extends those permanently. So now there's no deadline. It's just going to continue on as it has for the last several years. Now, this is a big benefit for real estate investors, but frankly, it's a big benefit for everyone because every single tax bracket is impacted and additional tax brackets have been added to reduce your overall taxes. So even the very lowest tax bracket, which is 10%, it increases from a $10,000 threshold to higher than that. So even the lowest of the lowest income still benefits from this extension. And then obviously, as you move up the brackets, the creation of new brackets, and then getting into the top brackets, it's going to stay around 37%, I think, instead of going up to almost 40%. So nice benefit for every single income level. And it's no change from what we're used to. It's just an extension of what we're already in place that was set to expire. So the next one is increase in the standard deduction. And I thought this was very interesting. We know that the itemized deduction on our tax returns is kind of a pain in the ass. But people want to deduct their home interest and they want to deduct health expenses. And if you're over the standard deduction, you get the privilege of filing the itemized deductions and getting a bigger benefit on your tax returns. But what the IRS has been trying to do, and this is same thing as with the big beautiful bill, what it's trying to do is reduce the number of itemized tax returns that they're looking at, basically. So if they can increase the standard deduction, more people fall under that standard deduction, less people are filing for itemized deduction. It just makes the entire thing easier. So the standard deductions are going to be $15,000 for an individual, $30,000 for a married filing jointly. And then it's going to be increasing in 2026 to $15,750 and $31,500. So that's a pretty significant, frankly, increase in your standard deduction. Big benefit here to, maybe someone that's renting doesn't have a home insurance deduction, that sort of thing. They're going to see a pretty significant reduction in their taxes with this aspect of the bill. The next one is SALT, which is the state and local income tax. You probably heard a lot about this. This is one of the ones that have been in the news, in the media. I've been reading a lot about it. And it's primarily because of places like New York and coastal towns, California, where property taxes are so high. When the SALT had a cap of $10,000 on it. So any tax that you paid to state and local governments that was over $10,000 was not deductible on the federal tax return. So you're paying a lot in state and local taxes and not getting any benefit on your federal return. So they're going to be increasing that. So this is a pretty significant benefit to anyone living in the high tax areas. So the cap before was $10,000, like I said. 2025, it's going to increase to $40,000. So basically a 4-time increase. And in 2026 is going to be $40,400 with scheduled gradual increases in that limit of 1% a year going forward. Again, pretty big benefit if you're living in one of those high tax areas. Okay, next one, estate tax. This is another one that I've read quite a bit about. Hopefully we all are going to fall into this when we're no longer on this beautiful earth. But what's happening here is the exempt amount from estate tax, that amount is going up. So it was 5.5 million. So anything above 5.5 million was tax, had an estate tax or a death tax on it. So it's 5.5 sounds like a lot, but it's actually rather small when you think about what you're able to accumulate over a lifetime. So I think the increase here is going to benefit, obviously this is the higher net worth individuals, but it's going from 5.5 million up to 14 million now and 15 million in the next year. And it sounds like that's going to be capped at that 15 million mark. So any amount up to 15 million tax-free when you die. Anything over that, you get a pretty big, steep estate tax on that. So they tax you when you earn the income. They tax you when you spend the income. They tax you on the stuff you own, and then they tax you again when you die, right? So good news though, 15 million is going to be exempt. Next one that's going to benefit probably a lot of people. This is especially true for middle class. It's the car loan interest deduction. So if you buy a new car, it cannot be used. It has to be a brand new car, and it has to be assembled, or at least the finishing the finishes of the car need to be assembled in the United States. So actually put together the end part of this in the United States, and then you would qualify for up to $10,000 in deduction on auto loan interest. So if you decide to get a loan on a car, this is a big benefit. Now it's not business use, so that's already deductible as a business expense. So this is specifically for personal use transportation vehicles. It will phase out as your income level goes up. So I guess I misstated that. What is true is it's going to be benefiting the lower income, maybe lower middle class, because it's a $100,000 phase out. $200,000 if your spouse filed jointly. So not a huge number here that it phases out pretty early. So if you're able to get your income down below that, and you have a car that you're buying brand new, the interest on that car will be deductible. So I guess that's kind of cool. The big one here is bonus depreciation. So this is the one that we've been hearing all about as a real estate investor. This is directly benefiting us. So what I'm talking about when I say bonus depreciation is anything that's non-structural on a property that you purchase, or anything that improvements that you do to a property that would normally depreciate at a 20-year depreciation schedule or less, is going to be 100% deductible in year number one. So I know I went pretty fast over that. Let me back up and explain what depreciation is. So the IRS says that, hey, the useful life of a piece of real estate is X. It's dependent on if commercial resident. There's a couple things that it will depend on, but the useful life is X. So every single year you get to depreciate the value of that by an amount every year to equal that depreciation schedule. So let's say it's 39 and a half years on a commercial building, for example. If it's $1 million, you would take $1 million divided by 39 and a half, and every year you get that deduction on your tax return, even though it's not a loss. So we call this phantom loss. That's a huge benefit for real estate investors to depreciate property, because we are getting the tax benefit from it without taking the loss. Now, components inside the house or on the property, improvements are deductible on a faster scale. So personal property, for example, this could be the curtains hanging from your window or the appliances in your kitchen. Those might depreciate at a schedule of only 5 years. So it really speeds up the depreciation schedule and it allows you to take larger deductions sooner. And then if we know anything about time value of money, we know we benefit when we can take the money now and not wait over 39 and a half years, right? So the faster we can get the deduction, the better off we are as real estate investors. So this is huge. Now, if you buy a property now and you do a cost seg study, a cost segregation study, and you get the value of each of the components in the house, you could take all of the components that depreciate at 20 years or less and depreciate it at 100% day one to day and get a big benefit on your tax returns the year you buy the property. Now, there's a couple things here. It's going to also be for improvements on a property too. So if you're doing any tenant improvements or remodels on properties that you're going to keep, that would be qualify for the bonus depreciation as well.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com.
So a couple things here. You do need, in most cases, you need to do the cost seg study, especially in the more expensive properties. I am seeing those more often on residential rental properties, just so you can get a good understanding. It's something that's defensible to the IRS on what each component of the property is worth. Another thing, this is pretty interesting. It's not just improvements inside the house, it could be landscaping. So the grass and the bushes and the shrubs, even the sidewalk walking up to the door, they're all considered improvements to the property and can be depreciated. So little tip there for to help you with your tax savings. So to qualify, this is the thing I wanted to point out. If it's a brand new property that you don't own yet, you're not doing any improvements to it, it's just one that you're buying, the contract has to be after January 19th of 2025. If it's prior to that, it's going to fall into the previous depreciation schedule before the big, beautiful bill was passed. And you're going to have to follow that schedule, which is not the 100% depreciation. It's still sped up a little bit, but it's not quite as good as the full 100% bonus depreciation. So I think that a lot of real estate investors are celebrating the one big, beautiful bill primarily because of this, the bonus depreciation. Okay, so those are all the big ones, guys. That's going to help you, the real estate investor. Make sure you're talking to your CPA about these, because I don't know that all CPAs are going to be searching for these specific things when they're doing your tax returns. You know, a lot of CPAs, I love them, and it's unfortunate that I say this, but some of them just want to crank out returns and they're not really digging in to save you the money. But if you point it out to them and say, hey, what about this possible deduction? They might look at that, or they will look at that, and then there's some potential savings there. So you're responsible for your own tax savings with the help of a CPA. It's not their responsibility. Okay, so now let me go into my bonus section here. So this isn't going to impact all of you listening, and it's not going to impact all real estate investors in general. But some of these are pretty cool, guys, and some of these I think will help you save some money. The first one, I haven't read anything about this until I got this email from the investment banker, but the senior deduction, they're calling it a senior deduction. And the information that I have on this right now is if you're aged 65 or older, so basically to qualify, you just have to be old. Well, not that old. I actually think 65 is pretty darn young, but they're considering that a senior. So senior deduction, 65 years or older, and you can take a $6,000 additional deduction per qualified taxpayer. Now, this does phase out $75,000 a year in annual income, and it'll start to phase out. So check with your CPA and see where you fit into that, and try to take advantage of that senior deduction. The next one is a child credit. Now, this is already intact. We already know about this. It is going to be permanently increased to $2,200 per child per year. So that's kind of cool. The problem here, though, is it does phase out annual income of $200,000 for an individual, $400,000 for married filing jointly. So $2,200 per child per year in a credit. So this is not a deduction. A deduction reduces the amount of income that is being taxed, right? So it's not a one-for-one. It's a deduction in the income, so you're taxed on a lower income. A credit is money to you, directly into your pocket. So credits are far better than deductions. They're both good, okay? We like them both, but credits are far better. This is a credit. And it is going to be indexed for inflation. So you'll see that number go up as inflation goes up. Okay, the next one, this is pretty funny to me, actually. They're calling it the Trump account. So we're going to be establishing Trump accounts. Now, there's not much information, and it's not even intact in 2025. It starts in 2026. But I think a lot of us could and should be taking advantage of this. So listen closely to this one. The Trump account is a tax-deferred investment account for kids. So for your children, grandchildren, nieces, nephews, any child under the age of 18 should qualify for this, and it's a tax-deferred account. So the contribution is similar to like maybe a Roth IRA, where you're not getting any tax deduction for making the contribution, but it will grow tax-deferred. So the reason this is a big benefit is tax is really slow growth. So if every year I'm making money and I got to pay tax on that money, my account reduces by the tax amount, right? And then it grows, and then I got to pay tax, it reduces, and then it grows, and I got to pay tax. So it slows growth, and it's significant, quite honestly. Now, that's not true with tax-deferred accounts like HSAs, IRAs, and now Trump accounts. It's not going to slow you down, so it's going to be able to grow much faster. Now, you are going to have to pay taxes on both sides of it. Like, it's post-tax dollars going in, and you get taxed when you come out. But it's the deferred gain there that really accelerates the growth. So it's a $5,000 per limit per child, combination of everybody contributing to it. So if parents, grandparents, uncles, if everyone contributes, the max you could go is $5,000 per year cumulative. I said it's not deductible. It must be invested to qualify. You must invest in U.S. stocks, which is easy enough to do. And it's locked in until the kids are 18 years old. You can't get that money out. I didn't see what kind of a penalty it would be if you get it out. They're still sort of designing this. It's not quite clear yet on all of the details, but it is clear that it's going to be locked in until the kids are 18. Final one here, the final bonus one, newborn pilot program. Sounds crazy. And this, again, is not fully designed. There's actually not very much information about this at all, but it is free money, so I wanted to mention it here. Each newborn will get $1,000 from the government deposited into a Trump account for newborns. So it's just a free $1,000. Here you go, it's free. To get this, the child has to be born in 2025 or later, and you have to opt in. So this is one you got to make sure you're talking to your CPA about. Are we opting in for the newborn pilot program, which doesn't even start till 2026, so don't call them this year. 2026 and after, we should see this. And then the government will just give you a free $1,000 and put it into a Trump account to invest in U.S. stocks. So again, I'm not a tax professional. I am not probably qualified at all. I'm just sharing information with you that I've learned, what I've researched, and what I've read. So it's based on what I've personally read, not from going to school for it or being qualified to give you advice. But it is things that I think can save you some money, so I wanted to chat about it. So hopefully you got some value from this episode. Kind of an interesting, different one that I normally do. But I do think it would benefit you. So I hope you got value. If you did, please 5-star review. Please share this with a friend, and please make this day a great one.
Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.